why super is very important. Enjoying your retirement means having the financial freedom to live without worrying about money. You have worked hard for many years to build your superannuation, and now it's time to make that super work for you. Once you retire, you can withdraw your super and use it to pay off your home invest elsewhere. Treat yourself with a holiday or simply keep it invested and commence a pension. Your super can be with a public offer fund where you have nominated to your employer to contribute, or alternatively, if you want to invest your super yourself, you can always set up a self-managed superannuation fund, also known as SMSF. SMSF is not for everyone, and there are many things which you cannot do, like use your super for today expenses or loan the money to your family, etc. There are also strict investment rules, and generally, SMSF cannot borrow. We are not financial planners and cannot advise if SMSF is best for you. However, we can discuss all the tax and accounting rules with you on what is involved in setting up and running a SMSF. Please call the office and make an appointment for this discussion.
Once you retire, you can withdraw lump sum, or your SMSF can pay you a pension. With account-based pension option, you can receive regular or once-a-year payment from the fund, or you can access lump sums as needed and choose how to invest your balance of your super pension amount in all types of assets, including property, crypto, etc. However, most choose fixed deposits and invest in shares and managed funds. We cannot give any investment advice. You can enjoy all in the income of the fund, tax-free once you commence a pension. There is a limit on how much you can commence a pension, known as transfer balance cap amount. Currently, it is $1.9 million, and from the 1st of July 2025, it will increase to $2 million.
To commence a pension from SMSF, you must consider some of the issues. Reaching preservation age, which is age 60, and retiring. You must have no intention to return to full-time or part-time work. You can work not more than 10 hours per week in the future. You can start your pension when you reach age 65, regardless of whether you are still working or retired. Depending on your age, there is a minimum amount which you must withdraw each year. This minimum amount is 4% of the 1st of July pension amount if you are under 65, and 5% if you are between the age of 65 and 74. You must withdraw a pension payment each financial year, and you may withdraw any amount above the minimum amount, including the entire balance of the pension at any time. Your pension can only be transferred to your spouse or to a dependent child upon your death. Lastly, once the pension has commenced, no further contributions or rollovers can be added to the capital supporting the pension. However, you can always set up a second pension up to your transfer balance cap amount. These are some basic issues, and every person thinking of commencing a pension must plan and put strategies in place before commencing a pension. If you would like to discuss some finer points with us, we can explore all strategies together and stop paying unnecessary tax on your retirement pool.
A person must have a director ID at the time they become a director of a company. You need to apply for your director ID prior to being appointed as a director to ensure they are compliant with your obligations. You may apply for a director ID if you intend to become a director within the next 12 months. It is an offense to not have a director ID when required. However, the law enables the registrar to extend the time for a director to apply for their director ID. The registrar cannot proactively extend a director's time to apply. A director must apply to the registrar for an extension of time. A request for an extension of time to apply should be made before a person applies for their director ID. If you are a director of a company and do not have director ID, please contact us if you need our help in this matter.
Many do not have a will. This comes as a surprise to many people that a will does not control any money which is in your superannuation. Super can only be paid out to dependents. Generally, the super fund's trust deed determines how your super gets paid out. Most public offer funds or industry funds, such as Australian Super or HESTA, give you a death benefit nomination form at the time of joining the fund, and you fill out who should get your super on your death. In a SMSF context, your SMSF trust deed determines how your super will be paid out on your death. You, as a member of the fund, must also inform the trustees of the SMSF on who should get your super on your death on a death benefit nomination form.
There are two types of death benefit nominations. One is binding and other is non-binding. The key difference being that if a binding death benefit nomination form is received by the trustee of the SMSF, the trustee has no discretions on whom to pay the death benefit to. But if non-binding death nomination form is executed by the member, the trustee is not obliged to follow it, but only consider it. The only time a will has any impact is where the benefits are paid out of the SMSF to the estate of the member where the legal personal representative is nominated on their binding death benefit nomination, or where the fund trustee exercises that discretion. The will then prescribes what happens to those assets, including whether to pay directly to nominated beneficiaries in the will or use testamentary trusts or superannuation proceeds, trust. Many wills prescribe that particular assets should be paid to a particular beneficiary.
If superannuation death benefits are paid to adult children over the age of 25 via a will, some portions can be taxable in the hands of the children, up to 17%.
As always, anything to do with an SMSF requires review of the current trust deed, and any death benefit nominations is therefore incredibly important to ensure benefits are paid as intended. The last thing you want is your kids be in dispute and your non-action on who gets your super after your death. This can result in your child potentially disinheriting their siblings. Let us know if you want to discuss this issue further and how we can assist in streamlining your wishes. If we are not able to fully assist you, we will refer you to some estate solicitors who specialize in estate planning.